When you start something new, and if you're anything like me, as a young person, you don't necessarily want to listen to your parents' experience, which is funny because I've kind of done the whole circle back around to some of the guiding lessons that they gave me about investing. So what I wanted to do today was, for those of you that are looking to start investing or have started and are early on in your journey, I wanted to talk through some of the top things, the key takeaways over the last 16 years of teaching investing in particular.
You're listening to Property Investor Tales, stories from the front yard. Here's your host, Tabitha Bright.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha Bright and I'm the head of coaching here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier. Today, I did want to turn it on its head. I've been coaching people on investment for the last 16 years. I've invested in property myself for well over that. And I wanted to share some of the top tips that myself and the other coaches here at Positive Real Estate have gleaned along the way about what makes a successful investor. So hopefully a not to be missed conversation with myself, if I can say that. Come and learn all about the top tips to being a property investor. Enjoy. Morning, folks. So this morning on today's podcast, I was thinking of doing something a little bit different. I've been coaching people in this arena on how to buy investment property, how to create a portfolio through Positive Real Estate for around the last 16 years. Prior to that, my hubby and I had invested. I've been investing for probably well over 25, 30 years. I'm in my mid-50s. So, we've had a pretty good crack at it over the years. Prior to that, my parents had invested in property, and prior to them, my grandparents, odds and sods and bits and pieces, but it was in our blood. So it was something that I understood. Now, that didn't make me special or particularly good at it, I might add, initially, because like anything, when you start something new, and if you're anything like me, as a young person, you don't necessarily want to listen to your parents' experience, which is funny because I've kind of done the whole circle back around to some of the guiding lessons that they gave me about investing. So what I wanted to do today was, for those of you that are looking to start investing or have started and are early on in your journey, I wanted to talk through some of the top things, the key takeaways over the last 16 years of teaching investing in particular, that I've gleaned. And some of them are very simple lessons. I don't think there's anything that, you're going to jump out and go, oh my God, I never knew that. But sometimes just hearing them said again can land and make a difference in your investing, because there's a couple of key things that we coaches see that make the difference for people investing. So I've got a whole list here of everything I could think of that was really important to your investing success outside of your income and having deposit funds and all of that kind of stuff, because that's a given, folks. Unfortunately, the way that the world of property works, generally speaking, there can be exceptions, is that you need your deposit, you need to service for a loan. That usually means you need a job. And you buy property that way. So we're assuming all of that. So in no particular order, these are the key lessons that I've learned over the last 16 years. Number one, be open. Sometimes I see clients that have a closed idea about what investing looks like, that it has to be a certain type of property in a certain neighborhood, a certain square meterage that they can do a certain thing to, and nothing else will fit the bill. Can they be right? 100%. Can they miss out on the market or not find the property that they're looking for in a time frame where they don't miss out on opportunity in the market? Yes. And this is probably the biggest thing. I've had a number of clients that have held on looking for a perfect property, wanting a very specific idea of an investment property. And when it's an investment property, it's very different to buying, or it should be very different to buying your owner occupied. It, contrary to what a lot of people say, it does have to have an emotional connection. For years, I always said, no, it's all on the numbers. While that is also true, what we know is that when a property has the ability to get an emotional connection, it gets you better capital growth. Because the better the property you buy with the better emotional connection for people without overpaying for gold taps, means that people will stretch their budget to purchase a property that they have emotional connection with, thereby increasing your capital growth. If you are going to only buy property that appeals to an investor and are going to buy like an investor, then investors by nature want to bring your price down and will negotiate in a different way to somebody that has an emotional connection. So just bear that in mind, because investors will try to bring the price down. An owner occupier wanting to purchase your property that has an emotional connection will push that price to their maximum budget to secure the thing that they want. So be open, because it might be that the best bang for your dollar, the property that has the most emotional connection that you can purchase due to your price point, might be an apartment, or it might be a townhouse. It may not be a 4-bedroom home on a 700 square meter block, because in order to get that one, you might be pushed out into, further out of the CBD, further out from amenities. It might mean that you have, you're in an area which has a lower wage per head, which once again means that the lower the income, the lower the affluence score in an area, the harder it is for people to stretch to pay rent increases to support your cash flow and capital growth on your property when they emotionally purchase. So always buy the best thing that you can possibly buy for your dollar, and don't be shy of just stretching it that little bit to get a really good quality property. Where we've seen people get good quality properties, we've seen some phenomenal results. We even had some results as recently, and I will stress, this is an extraordinary result. Clients getting valuations 200, 300, sometimes 600K above purchase price on, a $1.2, $1.3 million purchase. So they've stretched and they've got a fantastic result. Now, a lot of that is market timing, and we can't necessarily time markets, but I'm going to talk about that in a second. The second lesson I've got is don't chase cash flow. While cash flow is important, cash flow is the blood of your property. Your capital growth is your profit and your business working for you. So you have to have the cash flow of the property. But when we buy good quality property, often here in the Australian market at any rate, often that means that your rent yield will be lower, because the better quality the property, the lower the yield often is the case. Now, there can be ways around that. You can Airbnb, you can short-term let, there's medi stays, there's a whole range of options to increase your cash flow. But in my experience, you are better off buying a better quality property with a 3.5% yield and paying 5% interest, and focusing on working with a really good property manager in a really good area to get your rents up as quickly over time, in order to get your cash flow neutral and then positive in around, it usually works around that 5 to 7 year time frame, because your capital growth is far going to outstrip the odds and sods that your cash flow gives you. I remember when I first started investing, my hubby and I, we'd read all the books at the time, doing the rounds back then with your Robert Kiyosaki, your Dolph DeRues, all those guys. And they were all big about buying in the US. They were all US based at the time. And the US has a very different housing market, as we know, especially after the GFC. And there is a predominance of cash flow in the US. The yields are often high. They can be 20%. That doesn't necessarily make them a good investment, as attractive as that sounds. And my hubby and I, we'd come over from New Zealand and we arrived here in Australia and we thought, we need to buy some cash flow positive properties because that's what we're reading in all the books. And there weren't groups like us back then to ask. There were a few sort of fledgling groups, but nothing really underway as to teach you how to property invest. And banks weren't particularly helpful, and I didn't want to listen to my parents. So we forged our own way, read a few books, etc. So then we looked around, we put ads in the paper, we buy houses, all of that kind of stuff, trying to find properties that would have a decent yield. I was looking for a 10% yield in the Melbourne market. That's how naive I was at the time. So, that didn't work for me. I tried tricky stuff, subdividing, all of that. I couldn't get the numbers to stack up. So we ended up going back to New Zealand and buying some property in a town called Dunedin. So some of you that are from Dunedin or know of New Zealand, have been to New Zealand, might be familiar with Dunedin. So it's a town with a large Scottish heritage. It's cold. I don't think anyone would mind me saying that. It does have some beautiful beaches. It's got Lanark's Castle. It's got all sorts of stuff going for it. It's also got a very big student population and Otago University down that way. And what that means is there's some good student yields to be had. So we trotted down over there and we bought some property, and we ended up with a 14.9 and a 15.2% yield on our properties, which we thought, seeing we were borrowing at about 8% at the time, that it was cracker. But the properties were cheap and the cash flow was meager. There were some expenses from investing overseas. Even though we were Kiwis, we were still based as tax residents in New Zealand. And it was a pain in the butt managing properties across the ditch. And at the time, I was very keen to create a $200,000 income for myself from property investing. And I thought, okay, well, if each property is netting me after expenses, the money coming across the ditch, the everything else that goes on with property, I get about 2, 3, 4 grand in the hand. I'm going to have somewhere between 50 to 100 of these properties is what I worked out. Because there's another challenge with relying on cash flow to retire you. Unless you pay that debt down, you're also at the whim of interest rates. So if interest rates goes up, your cash flow gets crunched. You can't always raise the rent as soon as you want to, as soon as your interest rates go up. So I was having this kind of challenge going, this just doesn't make sense. I don't want to have to manage even 50, even 10 of these types of property, because the hard work chasing, students who are spending their money on beer and hot chips and a rugby game rather than, maybe that's unkind. Maybe they were spending them on living and supplies for uni. Maybe, I don't know. It's a bit of a student party town. I just didn't want to be chasing people for that. My property managers were having to go around and get the cash off them in person. One property manager ran off with a whole lot of the cash. Like it was mayhem. So I really learnt early on, don't chase cash flow. You want good quality properties that are easy to manage, that are going to perform for you long term. And I looked around the neighborhood, and I live here in Prahran in Melbourne, and I thought, geez, if I'd taken that same amount of deposit that I sunk into 2 or 3 properties in Dunedin and I just put it in the property across the road here in Paran, instead of netting over, say, 7 years, let's be generous and call it 100 grand. It wasn't anything like that, but let's call it 100 grand. I would have made probably 500 or 600 grand in capital growth in that same time here in the Melbourne market. And that's the power of capital growth in a neighborhood that has demand versus some cash flow. So be very careful of choosing cash flow. Don't go to as your strategy. Don't end up in regional towns. Don't invest in student accommodation. Not unless don't do short-term hotel stays or some of those Q resorts and those kind of guys, particularly in tropical areas where there's a lot of holiday letters. Well, often, you can buy a couple of rooms cheap and they talk about the cash flow being 13% and stuff. But by the time you net all the expenses, you end up with a couple of grand if you're lucky in your pocket and not much else. And a property that's also quite hard to sell. So just make sure you understand what you are trading with any deal you do. And that will bring me to my third point. There is never any perfect deal. Never. No matter what anyone tells you. Some of the guys frame it differently. The people that have been in property a long time, they'll say the deal of the decade comes along once a week, which is also true. But with any deal that is got an amazing thing like a big discount, or the ability to do something to it, or it's I don't know what it might be, whatever it is, there will always be a corresponding risk. That's how deals work. And so always understand there's nothing wrong with buying good quality, boring property. You hold that puppy for the long term, your results will far outpace the, shall we call them, creative investors that are trying to stitch deals together and do tricky stuff and get sucked into a flipping strategy, buying and selling. They have troubles with property. The property doesn't do what they thought it was going to do. They move it on. Buying good quality property long term will never shortchange you over the long term. And often people don't want to hear this because it's boring. And Robert Kiyosaki was one of the guys who is an author, in case you don't know him, on wealth creation, one of the granddaddies of wealth creation. And he always says in his books, the reason that most people don't become wealthy is they don't like doing the boring stuff. So I am waxing a little bit lyrical, and I hope I'm not boring you, but if I am, my message to you today is suck it up. There's some gems in what I'm going to tell you. So be bored for 5 more minutes because I want to share some more lessons that I've gleaned coaching and working and teaching with people and investing over the last 16 years. So don't worry about being bored. I would far rather be bored and suck it up and have to do a little bit of grit and grind in order to get a financial outcome long term than be excited constantly and go around in circles. That doesn't sound like much fun to me. Don't try and time markets. You can't. No one knows. If we did, we'd all be on Time magazine. Like, economists will make predictions. We can see the fundamentals of the market and get an understanding of what's happening, but markets can be contrary. So get the best information, understand economics, invest in your education. You don't have to go to uni and do a degree. Just read good quality commentary, listen to great podcasts, understand the market, follow data. There's lots of good free data, SQM research, McCrindle, they do some great demographic research, understanding population movement. Dr. Andrew Wilson, we get him on to speak. He's one of Australia's top property economists. Sam Saggers, of course, Jason Witten, all those guys have awesome market commentary. Get on and listen. understand what they're saying, look for commonalities, and then buy when you can afford to. There's opportunity in a downward trending market. There's opportunity in a rising market. There's opportunity in a market at its peak. Don't try and time a market, because you will miss out on opportunity and you will kick yourself. You get in when you can afford to get in and you hold for the long term, and that manages out any of the little ups and downs that, are just part of any normal market on the way up, be it the share market, be it the property market. Understand finance. You can't afford to be naive when it comes to banks and finance. What often people don't realize is, and this is going to seem bleedingly obvious to some of us, however, when we start out, we sometimes don't connect dots. Banks are businesses. They are financial institutions, but they are businesses, and they have a charter or whatever it is that they need to create a profit for their shareholders. They have to be functioning institutions from a government perspective, from a APRA perspective, from an ASIC perspective. They have rules and regulations. So this means that they have to manage risk. So just because you get a low valuation doesn't necessarily mean your property's worth that. It means it is a measure of the risk of the bank at that given time and what they're prepared to lend in that neighborhood, in that apartment building for you at that LVR, whatever it might be. A market appraisal or a market valuation is a very different thing. When the banks order a valuation for finance, I beg your pardon, it is about managing their risk, and the valuer will give it a risk rating for the bank, not for you. You don't own that valuation, the bank owns it. So understand banks, understand how they see finance, because that just gives you an understanding of when to be concerned about a valuation, when to be concerned that you can't get lending, when to be concerned that the bank's making comments about the market or whatever it might be, because banks get it wrong more than anyone else. Sometimes banks are making commentary to cool the market or to put off their competitors or whatever it might be. A classic case was during COVID, where some of the big majors came out and said the market was going to drop 40%. It rebounded 20% the other way rather than went down 40%. They get it wrong. So it comes back to, don't try and time markets. Don't try and wait until a 40% drop's gone, because you would have missed out on the 20% uplift just by waiting. Sometimes you just need to make sure the numbers stack up on their own, regardless of what the market's doing, and move ahead. And that means that you need to be brave and you need to trust your own judgment. So this is sometimes why we end up having the client base that we have, because people need to be able to bounce stuff off people. They need to be able to sense check stuff. And a coach can be a fabulous way of doing that. However, it's not for everybody. So if that is not for you, then make sure that you are checking in with peers that are investing, online forums. But once again, be careful of the information you get in those, because you do have to be able to weigh up what's good information and what's, crappy information. All right. Don't expect too much from your property. Sometimes people get very disappointed when a property doesn't go up 200 grand, 600 grand in the first 12 months of owning it, or the first 2 years, or even the first 7 years. Property can be contrary. Doesn't mean you bought a dud. It just means that we know that property is a long-term, slower, often, not always, investment. And you need to be in it for 10 to 15 years minimum. If you're in it for shorter than that, go do shares or build a business or something. Property is a long-term investment for a great result. I have not met anyone, including myself, that has held property for over 20 years and not loved that property, because it has been given time in the market to do its thing. And the biggest regret I hear from everyone that asks that I ask, what is your biggest lesson with property? They say, don't sell. Because the thing they regret is the property they sell. And even though they might have made a couple of $100 at the time when they sold it, they have now missed out on hundreds of thousands of dollars if they'd just held that property or found a way to do it or had known that they could have. Yeah. So where possible, try not to sell property and don't expect too much from your property in the early days. It doesn't mean it's a bad deal. Next point, I've run out of, I lost count of how many, but it's 5 or 6, I'm pretty sure. Run it like a business. When you start investing, don't be hokey about it. Run it like a business. And if you don't know how to run a business, find out. Talk to your accountant. How do you set this up? What software should you be using? Don't have receipts in buckets. And you know what? I can be quite analog at times, but I am 100% digital and a big fan of that for property portfolios. Don't mess around. The ATO, you know, you want to be able to account for everything as an investor. If you have an audit, if you have any queries on anything that you're putting through, I like to get the most out of my tax refunds, but I do it by legally minimizing my tax, not by avoiding tax as an investor. And you have to keep good records and have good accounting practices. Run it like a business, my friends. And that goes for your other team members that you need, your 6-star team, we call them here at Positive Real Estate, because our team have 6 other members from finance to accounting to financial planning to property management, you name it. So every professional that you need as a suite for managing your property portfolio, you need to manage. You are the CEO. Don't go, oh, it's my property manager. They know what they need to do. Ba-bow. The buck stops with you. This is your responsibility. This is your investment. This is your business you're building. This is your financial future. Own it. Don't mess around with that. Manage your property managers, manage your accountants, manage your 6-star team, and you'll get a fantastic result. Build a team of trusted suppliers that you use as you progress through your investing journey. And, you know, you'll have lifelong relationships with some of these people. You know, some of my property managers have been with me 15 years plus. So, you know, it's not to be sneezed at, the relationships and the bonds that we build during this journey of investing. So that's another tip for you. 6-star team, run it like a business, track it, systemize it. It's a tip for those of you that are less confident. Agents will often know less than you. So sometimes, often particularly as women, we defer to authority. Don't trust your gut, trust your research, trust your judgment. Often agents will know something very particular about their market segment, but they won't understand economics of the area unless they're passionate about it and unless they're making that part of their career move, which a successful agent in my book should always do, is understand how to talk to investors, understand yields, understand what makes a good investment, what would be the key selling points. But if they're not there, if they are used to selling to homeowners, if they know a very boutique part of their market, you know probably more than them, and trust your gut on that. Do not fall prey to headlines. So as I alluded to with the bank saying that markets will drop 40%, you know, be careful of those headlines. We see it all the time. Queensland's going to change the rental laws. And yeah, they probably will. What does it actually mean for you? Be specific. It might mean something so small. It might, you know, the chances are that it's going to blow your investment portfolio upside down on its head is very unlikely. So don't have a knee-jerk reactions to the headlines. Don't get caught up in the drama. Just understand if it bleeds, it leads. A journo friend of ours told me that if it bleeds, it leads. So the papers, the media, they're looking for headlines. Look at everything with a sensible eye. And if you find yourself getting a bit emotional about stuff, I usually go for a run. That's my way of shaking it off. Find something to shake it off. Very, very important. And my last tip for today's lesson: do something towards your goal of investing every day, even if it's just small. For my running and fitness goals, because I love running, I had a trainer at one point who said, when I was injured and I was feeling very flat about it, and he said to me, Tab, whatever you do, don't stop. Just do something every day towards your goal and you will pop out the other side. And I thought, okay, well, I can apply that to other stuff too. I can apply it to investing. And that 1% rule of just doing something, it doesn't matter what it is. It might just be sorting out a few receipts or making that call that you were going to make, or whatever it is, do something every day towards your investing goal. Learn something, read something, talk to somebody, look something up on the internet, whatever it is, do something every day. Because there are 3 important stages to investing that Jason, Sam, and the guys here at Positive Real Estate talk about: acquisitions, consolidation, and lifestyle. People often think the acquisition stage of investing is investing, that it's all about finding a great deal, going out, buying it, and having that hero moment when you get that amazing deal. And while that certainly can be a big part of investing, there's 2 other stages that often get forgotten about, and the other stages that stuff people up the most. Because Sam Saggers, he talks about how we're human beings, and the thing that stuffs up our investing the most is being human, getting bored, getting sick of stuff, getting frustrated with stuff, and selling it. He said that the human factor messes most investment strategies. And once you stop purchasing, or you hit a roadblock and you can't purchase anymore for the foreseeable future, and you've got to pay down some debt, and et cetera, before you can move on again, we move from acquisitions to consolidation phase. And in that consolidation phase is where, if people are going to stuff themselves up, that's where they stuff themselves up. You get the rare odds and sods, the special people that will buy a incredibly dud deal and stuff themselves up. But that's pretty rare, to be honest. Most people will stuff themselves up in consolidation phase because they will hold the properties they've bought. They'll hold them 2 years, 4 years, 6 years, 7 years. And then they go, God damn this property, it's not doing anything I want, I'm going to sell it. But if they'd held it another 3 years, 5 years, 7 years, it would have actually have done the thing. And then in that time frame, they go back and they go, God damn, I wish I didn't sell that property, because today it would be worth X, Y, Z. And sometimes you see properties do incredible amounts of increase in value, excuse the bad grammar, in a short period of time, because that's just how the market goes sometimes. It can be contrary. You can see 7 years of a flat market and 2 years where your property doubles in value. And if you've sold because you've got frustrated or bored, or you haven't taken the time to reacquaint yourself with why you bought that property in the first place and focus on paying down some debt, getting your rents up, doing a minor renovation or titivation to it, or going and getting a hobby and totally ignoring the damn thing, if you haven't invested that in yourself to see yourself through consolidation phase, a lot of people stuff themselves up really poorly before they get to then enjoy lifestyle phase. So don't let that be you. If you need coaching, you know where to find us. If you're already coaching with us, hey, good to have you as part of the team here at Positive Real Estate. Otherwise, jump on, come to one of our workshops, come to one of our free events. We'd love to have you around and have you Excuse me, I'm choking. Got my tea here. Have you asking all those important questions. So that's it from me today. I hope that was useful, but they're the top things that I've gleaned, as obvious as they may or may not have been, for the last 16 years, coaching people from investing and seeing what makes an successful investor, because 90% of it's this, not the physical thing, and what gets in the way of that. So I hope that was helpful. Take care. That's it for me for now. Bye. Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.